Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today we're talking about companies that take the big risk, they pack up and they go offshore and trying to make their wares overseas, whether it be in Europe, US, Asia. And to help me talk about it and the pitfalls of going abroad is Andrew Mitchell from Ophir and Tony Waters from QVG Capital. So let's start with you, Tony. What do you think about companies that do go offshore? Inherently, there's a bit more risk about it, but even in the small end of the market where you tend to operate, it's happened a lot more recently. Good or bad?
Generally good, but again, you've got to look at the underlying business model. I mean, we don't buy companies just because they have overseas earnings, but often companies that do have overseas earnings means that they're globally competitive, and have a business model, where you do have a global pool of available consumers or customers, which means that you have a lot more leverage in terms of a growth pathway than you do if you're domestic only business.
So you don't shut the door as soon as you see someone saying, right, we're off, we're going somewhere, we're going away from home?
No, absolutely not. I mean, what it does often flag is it's an indicator that the domestic business is quite mature.
Yep.
So, you do have to be aware in terms of, the reasons why they're going offshore. But, it's very much a case-by-case basis.
Andrew, a lot of companies, especially in the small end of the market, have found their way, and, especially the US, and they say, if I can just get 1% market share, the market's as big as Australia. It's a big number, and we all get a bit excited and the eyes light up. Is that a good thing, or, as we're saying with Tony, that it's just a case by case? Well,
I agree with Tony that offshore markets, because of their size, they're fiercely competitive, and so you have to really pick the companies that you're going to back. A company that's outgrown Australia but doesn't really have an internationally competitive business model that goes offshore, history will tell you that's an investment graveyard doing that.
But so how do you know that? How do you know they're not internationally competitive?
Well, you've got to work out, have they got a cost advantage? Do they have a true competitive advantage? And then tend to just watch how they go offshore when they take their first steps. Do they take good steps, or is it to prove harder than they might have thought?
Okay, so then you got the added complexity of currency, and we've seen the currency move around a lot. You go back to 2011, bang, it was over $1 in the US, and then it came down, and it's been strong and weak lately. How do you factor that in, and does that make any impact on your decisions whether to invest with a company with overseas earnings?
Well, currency won't be a reason for us to invest in a company. It's a product of that investment, and we'll never make an investment because it's got a particular currency. However, it does provide you some diversification, especially in down markets. The Aussie dollar, being a commodity currency, will generally fall. So a global recession, offshore earners, US dollar earners will do particularly well. So we don't mind currency exposure, but we're never actually looking for currency exposure.
Okay, Tony, so when the Aussie dollar, everyone's forecasting it to be weak, do you open the book and say, right, who earns money in the US or Asia and Europe, and say we're going to focus in on these, or is that too simplistic?
No, I mean, it's definitely a factor. I mean, what is key is to understand the drivers of what a currency does to earnings, and whether that's likely to result in a beat to where consensus is in the market in terms of where that company's earnings is going. So, that's very much a factor in terms of what we look for.
Even though it could be short term?
Yeah, absolutely. Yeah, if it's not factored in, we think, by the market.
Okay, all right. Well, let's go down, and the Aussie dollar has gone. It was 78 cents or high 70s. It's back down to 73. So we're in a move at the moment. So what sectors would you be looking at? What areas might benefit from that lower currency?
Yeah, well, obviously there's a number of global growth businesses. If you look at Reliance World Corporation, corporate travel, or maybe even some that is not well considered by the market. For example, IPH, which manages patents in the Australian market, but has a large US client base with US dollar exposure, which is something that's not often understood by the market. So, we look at those drivers in those individual stocks and where that's likely to lead to earnings versus where we see markets forecast.
And is there a big advantage for people selling in the US and maybe cost base elsewhere under that scenario with a stronger US dollar? Is there many companies like that? Is that the big kicker?
Yeah, I mean, but at the end of the day, you can overemphasize currency. At the end of the day, it comes down to the quality of the product or service that's being sold. Obviously at the margin, you look at different sectors. Obviously tourism comes back more in vogue, but there's not much way to play that in this in the Australian market other than maybe Experience Co. Retailer, if they're buying cost of goods in US dollar and that's falling, then that increases their cost of goods. So that's something that you need to be aware of. So, you need to look at that over the next 1 to 2 years, past the hedging period.
All right. Well, let's get into the here and now, Andrew. Aussie dollar, where do you think it goes, and do you move your portfolio around to adjust for it?
Well, in a former life, I was an economist at Federal Treasury, and I used to do these sort of and look at these sort of things, and I can tell you currencies are particularly hard to forecast. We're at the bottom of the range right now at 73 cents. US dollar strength is putting pressure on the emerging economies, especially the ones that have got a lot of debt, a US dollar debt, with seeing their repayments go up. We're watching this quite closely. It's not good for global growth if you see the US dollar go higher. It's a watch for us. We can't forecast, but when it's on this precipice of breaking down the Aussie dollar, it does cause us some concern.
So you're not giving us a forecast, but you're kind of cautious that the US dollar might strengthen more in the Aussie dollar.
Yeah, certainly. We're cautious on a range of different scenarios, but one right at this point in time is that currency.
Okay. Under that scenario, can you give us a stock that you think that the viewers could say, well, this is going to benefit from the currency because it's good business and it's got leverage?
Well, I agree with Tony's point before. You don't want to invest in a company. You want to invest in the underlying performance of that business rather than the currency. But one company, it's a very small one for us, Redbubble. It's got about $350 million market cap in terms of its size. What it does is a global platform for artists to be able to sell their artwork on a range of different mediums, from pillows to t-shirts, 60 or so. And then it fulfills this by delivering it to the people who generally buy them online. This business is accelerating in growth. It's showing network effects, it's showing scale benefits, and it's really underappreciated, and no one really owns it in the Aussie market, and we think that the market will like it in future months when it puts out a few more results. So that's one for us.
One good long there. Tony, have you got something? It doesn't have to sound as exciting as Redbubble in name, but have you got a stock that can benefit from the currency and is powering anyway? So this is just a kick along.
I'm actually going to go to the larger end of the small cap market in Reliance World Corporation, a stock that is well held, but just because it's well held doesn't mean to say it's still not going to go higher. Significant exposure to the US dollar, disruptor in the marketplace in which it operates, in the push to connect market. We still see substantial growth in the US, and they've done a very sensible strategic acquisition, which has diversified their base away from the US, but offshore earnings in the UK with the John Guest acquisitions, and we see synergies there that could be well above what's been predicted in the market. So, it's an example where, if we like an underlying stock and then we see tailwinds rather than headwinds with the currency, that just gives us further confidence in that position.
So the little Aussie bleeder might be in the emergency room, but it doesn't mean our investors aren't out there running hard and finding opportunities.